Money isn't complicated. It's just a quiet little monster that eats your dreams while you pretend your investment app makes you a long-term thinker. 1. You think you're early, but you're actually the last clown in the circus. Investing glitch. Every beginner investor suffers from the same delusion. They think they've discovered an opportunity before the rest of the world. Meanwhile, the rest of the world discovered it last Tuesday and already dumped their bags on the unsuspecting hopefuls arriving fashionably late. Picture this. You confidently buy into some future of technology stock that's been pumped on every corner of the internet. You tell yourself it's undervalued, revolutionary, misunderstood, basically describing your entire dating life, but applied to equities. And then, shocker, the price drops 35% the moment you press confirm, as if the market personally received a notification that you just bought in. Because here's the truth no one wants to admit. The second something becomes mainstream enough for you to hear about it, the smart money has already left the building, cashed their profits, and is now sitting on a beach sipping something that costs more than your entire portfolio. But go ahead, keep believing you're early. Every circus needs an enthusiastic newcomer to clap at the elephants while the ringmasters loot the tent. Punchline. If you feel like you're discovering investments at the perfect time, congratulations, you're already late. 2. The long-term investor until the chart goes red. Survival instinct bug. Everyone loves to brag about being a disciplined long-term investor, but only when the markets go up. The moment the chart dips even 3%, that long-term mindset evaporates faster than your New Year's fitness goals. Suddenly, you're refreshing your portfolio every 10 seconds, like your retirement depends on witnessing real-time pain. You start Googling catastrophic predictions, doom charts, and YouTube thumbnails featuring red arrows pointing at the Earth exploding. You know the drill. And here's the absurdity. The market dropping is literally the sale you claimed you were waiting for. But instead of buying more like a rational investor, you panic scroll through financial Twitter looking for someone, anyone, to confirm your fear that capitalism is ending tonight. This isn't investing. This is emotional roulette disguised as wealth building. Real investors love downturns. Fake long-term thinkers experience a 24-hour existential crisis every time a candlestick turns crimson. The best part? As soon as the market recovers, which it usually does, you magically pretend you were calm the whole time, rewriting history in your head like a gaslighting historian with Wi-Fi access. Punchline. Most people don't invest for the long term. They invest until it feels slightly uncomfortable. 3. The diversification means owning 5 versions of the same mistake. Bug. Most new investors proudly talk about diversification the same way people brag about going to the gym twice a month. Loud confidence, disappointing execution. They think owning 5 different tech stocks is balanced, as if buying Apple, Microsoft, Nvidia, AMD, and a tech ETF somehow protects them from market volatility. That's not diversification. That's just choosing the same personality type in different outfits. It's like dating 5 people who all drive the same car, own the same sneakers, and cry about the same crypto losses. When the tech sector sneezes, your entire portfolio catches pneumonia. Meanwhile, genuine diversification feels boring. Bonds, industrials, REITs, international markets, basically the broccoli of investing. But beginners don't want broccoli. They want excitement, glitter, and charts that look like they're about to take off like SpaceX rockets. And that's exactly how they end up with a diversified portfolio that behaves more like one giant stock wearing multiple hats. Then, when the sector crashes and everything drops together, they stare at their portfolio like it betrayed them personally. Punchline. If all your diversified investments fall at the same time, you didn't diversify. You multiplied your favorite mistake. 4. The I'll buy the dip after it stops dipping. Paralysis loop. Everyone talks tough about buying dips until an actual dip shows up. Then suddenly that same confident investor becomes a terrified spectator, watching prices drop like a slow-motion horror film. First 5% down? No big deal. 10% down? Maybe I'll wait for confirmation. 15% down? Okay, I'll buy when it hits the bottom. 20% down. Actually, let's wait for a recovery. Recovery starts. I'll buy after the pullback. No pullback happens. Too late now. I'll wait for the next dip. Spoiler. The cycle repeats for the next decade. This psychological glitch is simple. People want certainty more than profits. They want the bottom neatly labeled with a blinking neon sign saying, "Buy now." Instead, markets give you chaos, discomfort, and opportunities disguised as disaster. Real investors buy during fear. Pretend investors wait for fear to leave, then buy at the top and blame market manipulation. The irony? People will gladly chase a stock that's up 40% but panic when it's 20% cheaper. That's like refusing to buy pizza when it's on sale and then paying double the next day because now it feels safer. Punchline: most investors don't miss wealth because of lack of money. They miss it because they wait for perfect conditions that never arrive. 5. The research means watching one YouTube video. Syndrome research in beginner investor language translates to watching a single YouTube video where some guy with a microphone and a galaxy-themed background says a company is undervalued and primed for exponential growth. Congratulations! That's not due diligence. That's financial astrology with better lighting. Proper research involves reading earnings reports, studying market conditions, analyzing business models, and understanding competitive risks, none of which fits neatly into a 9-minute video ending with "not financial advice, bro." But people love shortcuts. They love confirmation bias disguised as expertise. They'll spend more time comparing phone cases than evaluating a business they're about to invest thousands into. Then, when things inevitably go sideways, they act shocked, as if they weren't warned by the 47 disclaimers the influencer shouted at them. Watching one video and calling it research is like diagnosing yourself with a medical condition after a 20-second Google search. Sure, you can do it, but don't be surprised when the outcome is catastrophic. Punchline: if your entire investment thesis fits into a YouTube comment, you didn't analyze, you gambled with extra steps. 6. The timing the market will make me rich. Fantasy patch. Every rookie investor believes they can time the market. Every professional investor knows they can't. This creates a hilarious gap where beginners confidently jog into a battlefield that even Nobel Prize economists refuse to enter. People genuinely believe they can predict the perfect top and bottom using vibes, astrology, an uncle's opinion, a tweet. They'll sell everything because the crash is coming, only to watch the market rise for 3 more years. Then, when they finally buy back in, the actual crash hits, and they call it bad luck, instead of what it really is: delusional confidence mixed with terrible timing. The truth is brutal. Timing the market doesn't make you rich. It just makes you tired, bitter, and constantly wrong. Meanwhile, the boring long-term investor who did absolutely nothing beats them effortlessly. It's the financial equivalent of sprinting in circles while someone else calmly walks in a straight line and arrives first. Punchline: timing the market turns geniuses into gamblers and gamblers into broke philosophers. 7. The high risk means high reward until it means high regret. Glitch. Ah yes, the classic beginner belief. The higher the risk, the higher the reward. Technically true, until the risk punches you in the throat. High risk doesn't guarantee high reward. It guarantees high volatility with a side order of emotional damage. Beginners love risky plays because they want wealth fast. They want millionaire results with popcorn-level patience, so they pour money into speculative assets, meme stocks, pre-revenue companies, experimental tech, crypto coins named after animals, and anything promising to the moon. And for a brief magical moment, they feel like geniuses. Then reality visits. And reality doesn't knock. It kicks down the door and takes 70% of their portfolio hostage. Instantly, the high-risk investor transforms into a risk-averse monk chanting long-term while praying for a break-even exit. But the punchline is that people don't actually want high risk. They want the illusion of high reward without consequences, which is why they keep repeating the same mistakes like a financially illiterate time loop. Punchline: high risk doesn't make you rich. It just makes your portfolio scream louder. 8. The dollar cost averaging. Except when I feel emotional. Malfunction. Dollar cost averaging is the strategy everyone claims to follow. Invest the same amount regularly, rain or shine, bull or bear. Simple, boring, effective. Which is exactly why almost nobody sticks to it. Instead, they dollar cost average only when markets are green and their confidence is high. The moment the market dips, they suddenly transform into macro analysts, pausing contributions because the economy looks uncertain. Newsflash: the economy is always uncertain. That's the whole point of the system. But emotions hijack logic like a toddler grabbing car keys. Suddenly, the disciplined investor, who promised to invest every month, becomes a weather-dependent squirrel hoarding acorns only when the sun is out. Even worse, when markets rise sharply, they panic, FOMO buy 3 months of contributions at once, violating the entire principle they bragged about at dinner parties. Proper dollar-cost averaging forces you to buy when you're uncomfortable, which is why it works. Fake dollar-cost averaging lets your feelings run the show, which is why your portfolio looks like a roller coaster with seasonal depression. Punchline: dollar-cost averaging only works if you're consistent, not whenever your emotional horoscope feels bullish. 9. The ETF means I don't have to think. Simplification error. ETFs, the salvation of the lazy investor. And honestly, great choice. Until they start buying ETFs like they're collecting Pokemon cards. Beginners think an ETF is automatically safe, diversified, and immune to stupidity. Spoiler: it's not. You can buy ETFs that are basically one sector wearing a trench coat. Some ETFs hold 5 companies. Some hold companies you've never heard of because even the fund manager doesn't want to talk about them. But people don't look. They buy based on cool tickers like Moon, SPY, RKK, or anything that sounds like a spaceship or a superhero. They don't check expense ratios, sector concentration, or whether the ETF even matches their goals. Then they're shocked when their safe, diversified ETF tanks harder than a meme stock on a Monday. ETFs aren't magical safety nets. They're tools. And tools don't fix stupid decisions. They amplify them. Punchline: if your ETF strategy is, it has a cool name, congratulations, you're gambling in a suit. 10. The passive income investor who actually does zero work. Delusion. Well, everyone wants passive income. Nobody wants to do the part before it becomes passive. People buy dividend stocks expecting immediate cash flow big enough to quit their jobs, as if Coca-Cola is personally funding their retirement after a $200 investment. Or they jump into real estate convinced it's passive, only to discover that tenants, toilets, taxes, and repairs exist, and none of them are passive. Passive income requires upfront effort, research, capital, risk, patience, all things people conveniently skip because they heard someone on TikTok say, "Make money while you sleep." So they rush into investments, ignore fundamentals, then act confused when the passive part involves active stress, active repairs, active panic, and active Googling at 3 a.m. Genuine passive income is just income you don't have to micromanage, not money that magically appears from vibes alone. Punchline: if your passive income plan requires zero work, guess what? It'll also generate zero income. 11. The crypto will save me from being average. Exit. Fantasy crypto attracts 2 types of people: tech believers and people hoping for a shortcut out of mediocrity. Guess which group loses the most money? Beginners don't see crypto as an investment. They see it as their personal elevator out of financial normalcy. They don't understand blockchains, tokenomics, or market cycles, but they absolutely believe they'll retire next Tuesday. Then comes reality. A 70% crash wipes out their portfolio, and they declare crypto rigged, manipulated, or a conspiracy by whales, because accepting personal responsibility would break the illusion. The sad part? Crypto isn't the problem. Expectations are. People treat speculative assets like guaranteed salvation instead of high volatility experiments. And the moment things go wrong, they don't reevaluate their risk tolerance. They double down on the next moonshot coin recommended by a guy filming from his car. Punchline: crypto won't save you from being average, especially if your strategy is average. 12. The taxes are a surprise attack. Denial module. Investors act genuinely shocked when taxes appear, like there's some mystical dragon that emerges only once every 1,000 years. They'll make trades all year, take profits, day trade like caffeinated squirrels, then stare at their tax bill in April like it's a personal betrayal. Capital gains? Never heard of her. Short-term gains? What do you mean the government wants a cut? Even dividend investors forget that payouts aren't free. The IRS loves you, but not in the way you want. The funniest part is that most tax-related pain is completely preventable. Tax loss harvesting, long-term holding, retirement accounts, strategic selling, all tools any functional investor could use. But instead, they rage on Reddit that taxes are unfair while ignoring every strategy that could have reduced them. Taxes aren't a surprise. They're the most predictable part of investing. The only unpredictable part is investors pretending they didn't know this. Punchline: if taxes surprise you every year, investing isn't your problem. Math is. 13. The I deserve returns. Because I tried entitlement bug. There's a special kind of investor who genuinely believes the market owes them something. They read 2 blog posts, watched 3 motivational TikToks, and suddenly expect the stock market to applaud their effort with double-digit returns. These are the same people who think going to the gym twice should produce abs. They confuse effort with entitlement, as if doing research, aka scrolling through Reddit at 1 a.m., automatically guarantees profitable outcomes. Then, when their investment inevitably underperforms, they get mad at the market, instead of at their hilarious misunderstanding of how capitalism works. Here's the truth. The market doesn't care about you, your hopes, your dreams, your vision board, your manifestation journal, or your perfect Pinterest mindset. It barely cares about trillion-dollar companies. Why would it care about your $700 buy-in? People think they're early, smart, or disciplined. But really, they're just optimistic participants in a system that rewards patience, discipline, and competence, not enthusiasm. What's even funnier is that they blame external forces for every loss. The Fed ruined my gains. Whales manipulated the market. The universe hates my portfolio. No, friend. The universe is busy. This is simply the natural result of believing success is an emotional reward rather than a mathematical one. Punchline: the market doesn't care how hard you try, only how long you last. 14. The emotional support portfolio. Obsession loop. Some investors don't treat their portfolios like financial tools. They treat them like emotional therapy animals. They open their brokerage app 20 times a day, pet it with their thumb, whisper reassurance to their red numbers, then check again 5 minutes later just to confirm they're still stressed. These people don't invest to build wealth. They invest to feel something. Their entire self-worth becomes tied to whether the candlesticks are green or red. If the market drops 2%, their mood plummets. If it rises 4%, suddenly they're a genius, a strategist, and ready to lecture their friends on macroeconomics despite Googling the word yesterday. The irony? Constant monitoring makes them worse investors. Every tiny dip feels catastrophic, every spike feels like destiny, and every trade becomes an emotional coping mechanism. Meanwhile, the people who barely check their accounts end up richer simply because they aren't panic selling every time CNBC runs a dramatic headline. The market rewards patience, not emotional neediness. Punchline: if your portfolio is your emotional support animal, expect frequent heartbreak and expensive therapy. 15. The I'll start investing when life gets easier, lifetime delay. Virus. Here's the most destructive investing glitch of them all: waiting for the perfect moment. Spoiler: life never provides it. People delay investing because they're paying off loans, or raising kids, or planning a move, or waiting for a raise, or waiting for the market to drop or rise, or do literally anything that feels more comfortable than starting now. And so, their entire financial life becomes one long loading screen. The tragedy? Time is the only real superpower in investing. Missing your 20s hurts. Missing your 30s stings. Missing your 40s is financial self-sabotage wearing a friendly smile. People don't fail at investing because they're stupid. They fail because they wait. They wait for clarity, stability, peace, certainty, all things that don't exist in the real world. Meanwhile, compound interest quietly rewards everyone who started imperfectly rather than perfectly. The universe isn't waiting for your schedule to clear before it hands you financial freedom. That's not how any of this works. Punchline: the best time to invest was yesterday. The second best is before you invent another excuse. So, which of these investing glitches is currently ruining your financial future? Go on, confess your favorite disaster in the comments. Let's see which one wins the crown.